Small caps were tremendously expensive. If something is quoted at a PE of 100 plus, it has to correct. So I'm happy that the markets are behaving the way they should behave. If in India oil is going above 80, India is not going to do well. So if interest rates are going up, oil is above 80, I don't expect corporate profitability to grow as much as I would have expected when oil was at 65 and interest rates are low. So if interest rates are going up, small caps and mid caps will be the maximum affected. So they have to get corrected. So there's nothing abnormal as what. If NBFC, last 2 years we have been saying NBFC equity valuation has been going up big time, right? Why should an NBFC be valued at 3:1 price to book or 4:1 price to book? So those corrections have to happen. I believe that corrections in NBFC valuation will still happen, right? Because why should an NBFC be at a price to book ratio, which is borrowing wholesale, lending wholesale, has no franchisee value, and still the price to book is about 2. So all that corrections have to happen. So market in 2008 or 2018, over a long period of time, rationality will prevail. So it's prevailing. So it's good.
Okay. So those are just the introductory remarks, and we'll get into his thought process in the debt market as well. Sunil, you'll have to just pass on the mic, I guess. So should we start with the easy question or a tough question?
A tough one.
You have a mid-cap and a small-cap fund. You did not return money what Nimish did.
Suraj very famously speaks everywhere. It's time in the market and not timing in the market. If you're buying with a 10-year horizon or a 15-year horizon, which is what the equities asset class should be, it doesn't matter what you're doing. Because ultimately in the stock market, though you are buying in the market, you're buying the economy. And you look at it from a 10-year perspective of the Indian economy, yes, markets will be irrational, they'll price some things higher, lower. But if you expect everybody to read that this price is high now, I will now step away, I'll go into debt. 1 year later, I will come back into equity, then I'll do a hop, skip, and jump back into balance. I think that's not the way we are going to get the mass of the Indian investors who are still investing in FDs to come into equities.
The assessment is that what assumptions we had at the beginning of the year on crude, on interest rates, on earnings, they've changed. And how much of that markets currently are pricing in?
So before I answer that question directly, I just wanted to remind everyone that when we talk of 2003 to 2008, we always talk of it being a secular bull run. The fact is we have all forgotten that during this period, there were 4 large falls in the market within a month period. And the lowest of those were 15% plus.
Markets were second now,
29% plus. So what happens is when we start getting extremely worried on these counts, and that time our corporates were not as strong as currently the numbers are seeing, that we are seeing. India is fundamentally in a far stronger place from every aspect or every ratio that you can think of compared to what we were in the earlier time. The question that you're asking is that have we factored in the entire price rise? As of now, it looks to be, but if it goes worse, can there be more pain? There could be. But like Sunil said, we are not here for the short term at all.
First, explain the lay of land. What is your understanding? Paddles are being drawn when markets fall. Arey boss crisis hai, debt mein ho gaya hai, IL&FS mein problem hai. Good news and good prices don't come together. Right now, news is bad, but our price is good.
I don't know whether Nikunj used the example of a barber deliberately for me, but
no pun intended, trust me.
But yeah, you see, if we just step back, I mean, very often we get carried away by what happens today or what happened just yesterday. It's 1991 since, the time I started taking a little bit of interest in the markets. And I can think of so many events, You had the big Harshad Mehta scam, then you had Asian crisis, then you had the dot-com boom, dot-com bust, then you had, US 64 problem, then you had 9/11, then you had all kinds of crises here. 2008 happened, then 2013 happened, God knows what all. You look at what the market has done, okay? Market has given you at the very minimum, 35 times return in this time, okay? So the basic point is, it really doesn't matter. The people who really made money are the people with the ability to ignore the noise. Okay? If you allow yourself to be distracted by every noise that is made in your surrounding area, you will never make any progress.